to the first Your Financial Journey Investor Advisory Update for 2023. Hope you've had a good year so far. It's just a few days into the year. Hope some of your New Year's resolutions or 2023 goals you are moving in the right direction for, and that you haven't given up. That's half the battle, isn't it? Not giving up, just staying committed to moving forward and accomplishing what you feel called to do. So good luck on that. Godspeed, and I'm looking forward to hearing great reports as we talk about what you've accomplished in 2023. Along with that, in our meetings that we're doing with clients right now, we're also reviewing what's happened in 2022 and then moving that forward as we move into this new year. So I want to take some time tonight to do a little bit of both of those things to really move us forward as we look at how we want to go through 2023 and how we want to make the most of this year. So as I've told you many times before, your financial journey is actually the model of how we function here, that everything is a journey, and that your financial journey is helping you to figure out how to create, grow, protect, and preserve wealth for your family's future in today's economy. As we look at this advisory review, I want to take some time to really drill down on some of the critical points. As always, everything that we talk about here is to the best educated guesses, information, the data that we can show to support the concepts, beliefs, and processes we're working on. So hopefully you can take that information and use it wisely, understanding that there is no crystal ball here. No one knows for certain what's happening. We're all working the very best of our abilities, as are you, to make wise decisions in an economic environment that seems to move quite a bit. Anything that we talk about that might have to do with taxes, please talk with your accountant, maybe a tax attorney. Any estate design issues, please talk with your lawyer. Anything that might come to accessing borrowed money, your banker, your financial advisor, and anybody who's important in your decision-making process, because again, this is a team effort. We're all trying our best to make the best decisions to go forward and to accomplish what you want to do. So I love working on a team, and I hope you do too. So again, we want to make sure you're thinking carefully about each of these pieces and getting multiple pieces of information to make good decisions, sound decisions for you and your family. We will have a time for questions. I'll probably save that till the end so I can go through some things. I want to make sure we cover some really key points as we move into 2023 and what we're trying to do, because the fact is, I have been working through all of 2022 to make the most of how we want to go into this new year with some new strategies, some new planning processes, some new wealth management strategies. So we'll save the questions till the end, so please make note of that. And if you do write a question down, I assure you we'll take time to answer it at the end. But you can raise your hand or you can chat. Either one is fine with me. As always, we take time to take some moments to look at the market and economic review, as well as portfolio management diversification considerations. That's a mouthful. Just making sure how to divide out your portfolio, to diversify it in a way that makes sense for your long-term, mid-term, and short-term needs. I want to talk tonight a little bit more about fiduciary responsibilities and wealth advisory, because that's becoming a much bigger topic and has been over the last year. And I want to share with you how we're approaching that here at our firm. Take a look as a reminder, your financial dashboards and some of the things that I want you to think about how you might be able to use them to accomplish your goals this year. Again, we'll take time for your questions and then remind you of the next investor updates that we have going on. In regards to the economic environment that we're in, you will see that for GDP growth, which isn't coming out yet, I believe it comes out on the 23rd or the 26th. I apologize. I think we get the fourth quarter GDP numbers in. So far, it's kind of a plus minus. The first two quarters were down slightly. Third quarter was up, not too bad. It wasn't quite what you would hope for, but it wasn't bad, making it sort of flat. I'll show you some information here. That's what we sort of expect here in a moment as we come out of the fourth quarter and then into the new year. Business profitability has been kind of around like all over the charts. Some companies are doing pretty well, some are not. That's to be expected. That does happen as you cycle through sort of a sector rotation of the industries in America. They go through good times and bad times. So at this point, I would tend to say it's been more of a plus minus, not a minus plus. So that's a good sign. Unemployment rates still continue to be low, historically low, which is a wonderful thing. And interest rates have been rising, which is sort of challenging in a business environment, but actually it's quite nice as an investor opportunity. Money markets like ours right now are paying between 3.5% and 4.5%. That's not bad. I don't remember those days for quite some time. So there are pluses there. And for those investors who are wanting a more conservative approach, kind of miss the days of some better interest rate, that's a plus. For businesses trying to access capital, it's kind of a minus. So I think it's going to be kind of a wash here as we look at this as a choice at this point. So I would say if I'm looking at the 4 engines on this plane, they're all firing. One is firing normally, and the others are kind of in the mix right now, which may speak to how the volatility would look here the first and second quarter of this year, possibly. Let's take a moment and break down the markets and see what we have with that, because I've got some information on the markets themselves. So here we are again. Let's get rid of this. I want to talk about inflation in a second, but I will take a look at the markets. So when we look at the Dow, for instance, now this is looking back over a 2-year time frame. This 2-year time frame, we come back here, we can see the high in January of 2022, and then we can see how the market's gone down. And for those of you who've been on this update a number of times, you realize that I've been talking about the 50-day moving average or blue line, the 200-day moving average or red line, and you can see how this has played into it. We hit kind of a real serious downturn in June of this last year, rose back up very nicely by August, took a much bigger hit in September and October, has come back up, and you'll note that it has recently, back in November, surpassed what we had as that last uptick in August, which is a good sign. You'll also note, if you follow the gray line all the way across to the far edge, that we are currently right at that same area again. We are testing that ceiling of resistance, meaning that we're looking at having potential opportunity to break that and then possibly go higher. If you consider where we are today, the Dow closing today at close at 33,910, and then you compare that to the close back here at 36,799 or 36,800, you can tell we've got about 10% up if the Dow were to continue on up as it is. You would also note that the 50-day moving average is definitely in a positive trend, and we have the daily activity above it. We can see that the 200-day moving average is still heading down slightly, but it is still, at this point, not in the positive area we'd like for it to be. So we've got, at this point, 2 out of the 3 indicators looking better. We drop down here to moving average convergence divergence on the short terms. We can see that this time around, when the market broke, it barely broke down through the 9-day average here. And we can see it turn around and headed back up again. So I'm very curious to see what that means as we roll forward here into the next month or 2 months. So far, January has been a pretty good month. We can't complain about it. Starting here January 6th and then moving on up, we're certainly in positive territory for the month. All of these pieces together would cause me to say, well, from the Dow's perspective, it's not too bad at all. If I want to look at another one of the indexes, let's take, for instance, the S&P 500. What I see, similarly, but not quite the same. So here's the high back in January, but you'll notice that the disparity between the high of where we were back in January of 2022 compared to the high where we are today with the Russell 2000 or the S&P 500, we're just barely breaking that 200-day moving average. The 50-day moving average, the blue, is down here. It is moving back up again. We're seeing some interesting upward trend, but you'll note each high has still been lower than the previous so far. We will note, though, that the lows are starting to pick back up again. So we're starting to move into this place where, as they come together, that convergence divergence will force it either up or down. Now, compared to the Dow, which is the 30 multinational companies that represent various industries, the S&P is representing 500 different companies in these 11 industries. And so being a broader index, we can see that it's not reacting quite as exuberantly as the Dow was, which is important here in a minute. We can tell that it's kind of come up and taken off again on the short-term MACD, but still we're not seeing quite the excitement with the broader index of the S&P 500 as we had seen to the Dow. Let's go ahead and take a look then at the Russell 2000. So the Russell, we move back here, we see it had its high back in November of 2021. In January, it was coming back down. It's come down. We can see again that if we look at just the tops here, the ceilings of resistance, we can see that we're sort of stuck here, other than this one anomaly, we're sort of stuck here at this point where they haven't quite broken above this higher level. Now the Russell 2000, by its name, 2,000 largest companies in America. Obviously, we have a much broader group of companies in there, and so they're not getting quite the same growth. However, having said that, you will note the 50-day moving average is positive, and the daily activity for the Russell is still above that margin by quite a bit. The 200-day moving average is still negative. We're also seeing, though, the same kind of behavior down here in the short MACD. So we see that if we go back to the high of November, we can tell we have quite a ways to go to do that, much more than a 10% growth to make that happen. And so that gives us some pause for a second. Why aren't these keeping up? Why isn't the S&P and the Russell keeping up with the Dow? We'll come to that in one more second. Lastly, let's take a look at the NASDAQ. NASDAQ is the worst of them, has had the least excitement there. Certainly the high back in January, compared to the fact the daily activity is still just barely breaking above the 50-day moving average. 50-day moving average still hasn't shown quite that upward trend we'd like to see yet. So if I'm looking at this, also I did mention, I failed to mention that we're seeing a similar kind of behavior, but this time around we took a much bigger dip below the short MACD and we're starting to move back up again. So what does all this mean? Well, I don't know what it means, but I have opinions. And so here's my opinion. When a bull market or a bear market is over, you find that first thing that happens is the risk takers jump in, and the very conservative people jump in to the Dow, the multinationals, the blue chips. Those are the first two behaviors. We've seen that for sure. When I showed you on the Dow, we've seen money moving back into the Dow. That's what drives the market up, is money moving in. So that makes me think, okay, we might be moving to a place where this particular bear market or down market we've been experiencing may be starting to come to an end. But we don't see it in the broader indexes yet. Certainly with the NASDAQ, which is very tech heavy, we still don't see it there. And that has been one of the leading growth areas out of the pandemic. And so maybe that's part of it retrenching right now. Maybe that's part of what's going on, but it's still not there yet. So we've got the 500 companies in America, the 2,000, the tech-heavy NASDAQ, none of them showing quite that kind of support or excitement yet for the economy that the Dow is. But again, remember, the Dow, because it's blue chip and safe and strong, typically tends to be that first place as you move through sector rotation that people jump in. The risk takers will jump into the smaller companies, and there's some information that shows that could be happening too. But it doesn't mean it's over yet. It just means that we might be moving in the right direction. So those who aren't faint of heart, this might be the time to get back in again. This might be the time to go ahead and take advantage of that, understanding that you might see some volatility. We might see some up and down that we aren't looking forward to or not expecting, and that might kind of be scary for moments. But depending upon what comes out of these next 2 quarters, I was just talking with a number of clients today who were saying, oh my goodness, I hear that 2023 is going to be bad. I hear there's recession. I hear there's this. I hear there's that. It's possible, and certainly there are some indications those things are true. but there's also other indications that it might not be quite as bad yet, so that maybe once we get through the first and second quarters and move into the latter part of the year, we might see some more opportunity. Again, time and more information will give us that understanding. Having said that, let's take a look at inflation, because inflation is one of those things where it has certainly been heavy on the hearts of many people. You're looking here at the inflation, obviously back in June of last year, we hit a high, but you'll notice we have been turning down each month. So now we're at, in December of 22, we experienced 6.5% inflation year over year. That's not terrible. It's much higher than what we've seen before, and it does take us back to, if we go over here, for instance, 6.2, 6 point, somewhere in there, it takes us back to October, November of 2021. Be nice to get back down here to these lower inflations that we were so used to. Certainly, after all this inflation is said and done, we're going to be challenged by the fact that costs are much higher. Matter of fact, in this report further down here, it identifies, where did I read that at? I don't want to misquote what it said. Oh, there we are. U.S. Consumer Price Index, or CPI, was about $258, 258.84 in 2020, is forecasted to be as high as 325.6 in 2027. Comparing that, the monetary fund, the value of a dollar on the International Monetary Fund. So we can see over the next, well, since we're in 2023, the startup, we can see over the next 4 years that it's going to grow. We're going to have some more cost of living, but we also will see jobs which are very low on unemployment. We'll see corporations that are making decent profit. We'll see all those pieces come together, and so hopefully we'll see this inflation continue to tick down. Having said that, when we find that the printing of US dollars continues to create sort of that inflationary trend that we're struggling with a bit, hopefully we'll see government policy start to change and do that better. One last piece I want to hit on is GDP information. We don't have the current Q4 numbers yet, but they're coming out. We are expected to see those. It was the 26th. We're expected to see those, and the consensus would be probably around consensus 2.8. This particular website's viewpoint is about 1.2 positive, which would mean that we will end up with a slight growth for 2022, even though we had a couple of bad quarters or uncomfortable quarters. We would end up with some growth for the year. There is still question about whether or not we're going to see more slowdown in GDP growth, or maybe even negative GDP in 2023. Again, we'll deal more with that as we come into the next month's meeting, because we'll have more data to work off of there. I'm not going to make a prediction because honestly, I don't know. There's so many moving parts, and the economy seems to be so wonky right now. So I'm going to tell you that I see some blue sky out there. I see some clouds, but I do have a relatively strong opinion that I think by the end of this year, we could see sort of a normalization of market performance that would be a result of good or stronger economic performance. But we will continue to watch carefully and work through that process and decide how to divide out assets to make the best outcome for that. Let me go back here. So as always, diversification is our friend, not putting all of our eggs in one basket, casting our bread upon the water to 7, yes, to 8 portions, because we don't know what's going to work and what's not. So bottom line is that we continue to adjust portfolios. We became more conservative in September and October, and quite honestly, missed a little bit of that upturn, but we're taking a look now that we think this is, based on some of the information I was showing you, look like this could really be the start of that. And so for those of you who have a higher risk tolerance, we're going to begin moving some of these different models back up to more aggressive positions. We will talk with you who are not quite as comfortable, and we'll make a discussion. We'll have a discussion about that, make a decision based on what your thoughts are. But dividing out your assets into the various groups, identifying how not just one group did, but all of the groups combined did, is a big determination here by either dollar amount or percentage to make sure that your tactical consensus for all of your investments, both with us, what we call assets under management, or AUM, and assets outside of us, which we'd call AHA, assets held away. We're looking to see that your total portfolio shows a continuous movement forward, and work very hard to minimize risk on that at the same time. No guarantees, it's not possible in this world, but we do the very best we can through diversification and balancing out and trying to match your needs for cash reserve or income or probability or surety, tax minimization, understanding your risk tolerance, diversifying as this chart shows, and then using some of the tools of dollar cost averaging, asset cyclical management, waiting and maintaining entry and exit strategies to help balance everything out and create the best process going through difficult times and then coming out of those difficult times. So we're going to continue to be proactive wherever possible and reactive whenever necessary. And as always, your insight, your opinions, your concerns, and the goals you see will be critical to our thinking, to my thinking when I'm talking with you. So now, that's about all I'm going to hit on for the market update, economic update, because I think we're waiting for some more information, and I think as we come out of Q4, it's probably going to have a much better discussion next month for that. Having said that, though, this last year has been a big discussion in my industry, which is kind of inside baseball for you, about fiduciary responsibilities. It started in 2016, and it became this discussion about best interest and prohibited transaction exemptions, and looking at how we were handling qualified plans, not we, but the entire industry, looking at how, for instance, a plan administrator for a 401k has to be identified, has to have the process in place for to be classified as a fiduciary. I have a registered investment advisor license, as well as I work with a broker dealer where we are part of their investment advisory team. Not that we're part of their team, but we work with their resources. We use third-party managers, and we have some input in all of the processes that we do here. And I enjoy that, and that's because I've always thought of myself, ever since I started over 3.5 decades ago, as a fiduciary, whether I was identified as one, listed as one, or just wasn't. But I have always considered I want to be that fiduciary when it comes to helping clients maximize their family resources. But lately here in the last year or two, it's become a much bigger question about handling all the qualified money as people retire, they roll money out of 401ks into IRAs. What is that fiduciary responsibility to the advisor who's taking over that management? And that has been a much bigger question, which really fit fine for me, but we began to look at how we're going to manage this wisely to make sure that we really are stepping up our game, because in today's world now, everybody who is working with qualified plans has to be able to meet that standard. And we've been doing it, but now I want to say, how do we go one step further than everybody else? How do we provide excellence beyond the average? And so that's what I want to take some time to talk about today with you on how we're doing that. What is a fiduciary? I suspect probably everybody on the call has experienced that term before, or heard about it, or maybe even has some understanding of it. But I thought to break it down into sort of a working example. There are many kinds of fiduciaries. Directors of corporations may be fiduciaries for their stockholders, meaning they're supposed to make decisions in the best interest of their stockholders. Executors may be fiduciaries for trust accounts for the decedents, for those beneficiaries of that trust. Trustees may be fiduciaries for the beneficiaries in the accounts where they're helping to deal with the administrative responsibilities. Lawyers may be fiduciaries for their clients, because they're supposed to say, if I were sitting over in that seat, how would I want to be treated? Fiduciaries are people who act in a position of trust. They're expected to bring their best, their A game, to the discussion. But that language is even more important as you start to break it out and say, well, who is and who is not acting like that? So while every industry has different standards for it, and ours does as well, they typically fall to these 5 points about care and skill, loyalty, no conflicts, information, and accountability. And some of the common rules governing most fiduciaries are as follows. Fiduciaries must act with care and skill for the people they're caring for, they're serving, they're working with. Fiduciaries must act with loyalty to the beneficiary, doing their very best to try to figure out what's the next best move for that person, especially in light if I were in their situation, how would I want to be worked with? If I'm a risk taker, that's one way. If I'm a risk avoider, that's a different responsibility the fiduciary has to think about. Fiduciaries may not profit from their fiduciary position at the expense of the beneficiaries other than reasonable compensation. Reasonable compensation being decided by the entire industry what is reasonable. But outside of that, the fiduciary shouldn't profit off of some inside knowledge or some difficult situation or challenging situation the person they're caring for is in. So compensation is fine, but anything beyond reasonable compensation is problematic from a fiduciary viewpoint. And fiduciaries must inform beneficiaries about their activities and are accountable if they violate these fiduciary duties, meaning that they have to be looking at what the people they're caring for need. If something happens that it's not working out like they thought, they need to talk about it, try to do their very best to keep that person up to date and take their accountability seriously. Now, as I said, I've always, as long as I can remember being in this industry, which I started in 1986, I've always thought of myself as operating with this standard. But now, as I look at the fact that many people in my industry are being called to do this, and that's a whole other discussion if I wanted to share with you about the difference between salespeople and managers and fiduciaries and how that all fits together. But now I'm thinking, and as I always have, how do we bring excellence to this model as it is learning, as it's changing and growing right now? And so that's what I wanted to talk with you about, what we've been doing in the last year or so, and what we're wanting to do as we go forward. So let me share with you my experience working with different clients over this length of time. That I kind of come to realize that clients sort of fall into four groups from an advisory viewpoint. First off, there's the self-directed, the do-it-yourselfers. And that's great. I think that's a fantastic person. And we don't really do a lot of work with DIYers because why? Well, they're DIYers. I mean, if you're a guy or a gal who builds stuff at your house, you typically don't hire a contractor to come in and do the work unless you get beyond your expertise. So DIYers, they're wonderful people. I talk to them every so often, but most of the time that's not our primary relationships. And if they are, it's a temporary sort of thing where we're helping them with one thing. Which brings you to the second type, event-driven. Somebody gets a large bonus, or they get an inheritance, or they have a big tax bill, or they have some loss they have to deal with. Special circumstances. Those are people that usually when they come into the office or we meet, they will say, hey, I've got this problem, can you help me with it? And we take a look at that particular event and say, you know, we can, and here's how we might do that. Next would be the value-added advisory relationship. And that's that person who wants some assistance. They kind of want to run things themselves and do things. They maybe have an attorney or an accountant or a financial advisor or somebody who helps them with various pieces, but they kind of want to handle everything themselves, which is great. They just want some assistance. And then the last is the trusted advisory relationship, where that's somebody who wants team guidance. They sort of see themselves as sort of the CEO of their financial situation, and whoever they are putting in charge of that would be sort of the CFO or the COO, the Chief Financial Officer, the Chief Operations Officer, to keep everything working for Team U. So the bottom two, quite honestly, are where that fiduciary discussion can fit. Those who want some assistance, they're expecting a fiduciary thought process in it. Those who want trusted advisory, that extra relationship, they are demanding it, as they should be. The event-driven can also demand it, but what I've experienced over the time is to say that if I find somebody who's sort of event-driven when they come in to work with us, at some point they move back to who they really are, which could be a DIYer, or it could be that value-added advisory relationship, or it could be they're really looking for a trusted advisory relationship. And so that event-driven one has its own sort of model that it certainly involves fiduciary thinking, but it's the bottom two that I'm more focused on. And to be honest with you, I really enjoy the trusted advisor relationship the best because it's where you're the most connected, you understand their situation the best, and it's really quite honestly the place where you can operate as a fiduciary the best because you know enough to make the right kinds of decisions or share the right kind of information to match where they are. In all of this, there's sort of two questions I think that become incumbent upon you as you think through this process about where you might sit. And that would be, how do you make wealth management decisions? Your family wealth management decisions, do you do it on your own? Do you do it with your spouse? Do you do it with other people? How do you do that? And that might give you some clue as to where you are on this process. Second, what do you need from your wealth advisor relationships? What are you looking for? Understanding those two questions will help you understand where you are in the client-advisor relationship model. And that kind of then moves me on to what we're trying to bring to the table, because here, this is where you are, and then this is what we want to bring to the table to see how well that fits for you and for what we feel like we are skilled at doing. As a quick reminder, there are 3 phases for your financial journey. The first phase, where the green line is going up the mountain, that's the accumulation phase, or we might call it pre-retirement. It's not all about retirement, to be honest with you, but truthfully, most people do have a focus on that. And so during that pre-retirement accumulation phase, you might have other things you're trying to do, have children, raise children, put children through college, buy a house, start a business, do other things that you enjoy, take care of things you don't enjoy along the way. That's just part of the process. You get to the top of that mountain, you plant your flag, and you say, you know what, I am ready to retire or redirect. And then you start back down. That's where you go into the decumulation phase. And the first few years of that, there is sequence of return risk, meaning that if you have a really bad couple of years, in those first 5 years, it can absolutely blow up your retirement planning process. So we try to be very careful about that. As you go further down the plan, down the mountain, you then get to the bottom where you have EOL risk, or end of life issues. Those are the risks where, for instance, most people spend the bulk of their healthcare dollars in the last year of their life. All the other years combined, it's typically that last year where they spend the most. And so end of life issues, incapacitation, whether it's physical or cognitively, those are all issues that have to be thought about in that last phase of life. And then once you are done with those resources, now you transfer to your loved ones, the people you care about, the charities you enjoy, the friends, whoever it is that you want to prepare resources for. That's what that last phase is about. So the 3 phases: accumulation, decumulation, and transfer. And I'm going to point to 2 things here. One at the top where it says direction determines destination. All of our planning resources are designed to identify direction. It doesn't determine outcome. It determines a direction that you're headed, which points us to a direction or a destination that you might experience. And we want to make sure that people can see carefully, as we try to put together various calculations, that we are thinking this through carefully. I'd also like to point you to the bottom, which is, what's your desired return on life? Again, after working all these decades and working with a number of family members, I've never had anybody come in and say, or when I was talking to them in the EOL area, the end of life issues, I've never had anybody say, my goodness, I am so glad I made X number return this year. I'm so glad I have this much money. Nobody ever says that. What they say is, what did I do with what I had? Did I accomplish what I wanted to accomplish? Do I feel good with the outcomes of what I did with the resources I managed or was a steward over? And so that's what we're trying to do, is to help people figure out how to determine the direction they're headed, and then to identify what their ROL, or return on life, looks like, their desired ROL, to help them achieve that. To me, that just reeks of fiduciary, trying to help people figure it out. It doesn't mean that we're perfect. It doesn't mean we always get it right. It just means that that's what we're trying to do. And so what I'm about to show you are some of the tools that we use to do that. Some of you have been using them. Some of you haven't even started yet. And some of you have just sort of scratched the scratch. Now, as I look at this process, you'll see this pyramid, if you will. It's broken into 3 components: your personalized investment portfolio, your personalized risk management solutions, down at the bottom, your return on life financial plan. So from my viewpoint, up there at the top right here where it says, where we are, comprehensive financial advice helps create, grow, protect, and preserve your family's wealth through a defined wealth management plan that is balanced for your needs today and quantifiable for your future goals and desires. It doesn't mean that we can hit everything the way we want to, but it means that with a good blueprint in place, we stand a better chance of having the building come out looking like we want. With a good travel plan in place, we stand a better chance of getting to the destination that we want to accomplish. When I've done this in the past, and I've shown, for instance, just one of the 3 pieces, your personalized investment portfolio by itself is just standing there on its own. It doesn't have any risk management protection in there. So it can create and grow wealth, but it may not do a good job protecting and preserving it. Or another thing, your personalized risk management solutions, which has to do with insurance, protecting against loss of house or auto, life, disability income, etc., health issues, long-term care issues. A good plan there can help do that, but you've heard people say, I don't want to be insurance poor. Having a good resource to protect and preserve wealth is just as important as having a good resource to create and grow wealth. Now, at the foundation of that is your return on life or your financial plan, a blueprint that helps determine where you are and where you're going. And we've talked about it before, I'm not going to do it tonight, but the 4 key questions: percent sign, how much you have to earn on your money so you can retire or redirect and stay retired. Dollar sign, how much you have to save between now and the time you retire to make it so you can retire and stay retired. Work, how many years you have to work to be able to retire and stay retired. And if the first 3 aren't in good order, lifestyle is the last word. How much you have to reduce your future lifestyle by to make sure that you'll be able to retire and stay retired. Your financial plan, your return on life financial plan, from how this firm thinks about it, is about making sure you have that all figured out, and at least have a good plan to go forward, so that when you're on track you can tell it, and when you're off track you can also tell it. So in that box in the center it says, we believe fiduciary wealth advisory requires a vigorous financial planning strategy, and we're committed to providing that for our clients. And that's really the crux of what I'm trying to do, is not just to create an investment portfolio or protect against risk. Those are very important pieces, but it's about having a comprehensive strategy to move forward wisely. That's why we have these various resources. On the website, you go to our website, and then up here at the very top, you'll see this login. You click on login, it's going to bring you here. It's going to show you the 4 wealth management apps we use to help people think through the process of creating, growing, protecting, and preserving wealth. And it's not a, oh, here, go do it yourself. These are the tools that we use to have a good communication with you, and then use this to help you understand what we're saying and where we're headed. So you have your financial dashboard, you have your portfolio dashboard, you have your risk reward evaluation application, and you have your financial life plan application to help identify life transitions and life goals. So let me take a moment and kind of go through those. So the first one here, the one that everybody in every one of our clients has access to, is your investment dashboard. It's a dashboard that shows you your account details. It shows you performance details, give you quick links to various reports you might need, shows you which accounts are doing better, which ones aren't doing as well. Asset type shows you how everything is broken down, and the investment objectives for those different asset types. There's a lot more here, but if any of you sat with me for even 10 minutes in our office, you realize that we have gone through this report with you multiple times, and it's very quick. It's available 24/7, 365, so that you can access information. It's updated at daily, at the market close for some funds, hourly. It depends on what kind of information is reporting through, but it is designed to make it so you always know what's going on with your investments with us. Again, assets under management, AUM, that's us. AHA is anything that's not with us, but it's still part of your whole wealth management process. That information is not found in your investment dashboard, only the stuff you have with us. We also I find it after all these years of doing this, I find it very important to understand your risk and reward, what it means to you to accept risk, to have a portfolio that matches what your goals are, and to understand, and in this case, assets you might have with us and assets you might not have with us. You might have various assets in here, and we're applying a score to it, matching that score up to what you say your risk tolerance is. And then you might have assets that aren't with us, and we're matching that risk score up to come to an overall number and then individual number per asset. Now, I want to say something here very clearly. You'll note there's a little note down here. Financial calculators are a way to analyze information and help make predictions. They cannot guarantee outcomes. There is no guarantee on here. So while it identifies what the risk-wise GPA is and identifies a portfolio, next 6 months could be really good, maybe not so good. There's no guarantee that that's the case because this is identifying here. It's 95% probability. There's no guarantee on that it can do that. But again, direction determines destination. So we can see what direction this portfolio is, how various accounts compared to your risk scoring, and how the overall portfolio compares to your total risk score. That's the purpose of this, to help you have a tool to be able to assess where you are and then help us be able to make sure that we're doing everything in our power to help keep you on that track. We can then do a stress test with it and compare it. For instance, what happens in the 2013 bull market were to happen again, or the 2008 bear market, or if the financial crisis were to happen, what kind of experience would your portfolio work with that? And we have other tools that we use that I'll show you in a second, but the bottom line is that I think that especially from a fiduciary viewpoint or from a financial advisory viewpoint, we manage people's expectations maybe more than we manage money, trying to make sure that when things are not working quite like they'd like it, that we understand that and can help them make adjustments accordingly. So our goal is not that, oh, we're always going to outperform the S&P 500, or we're always going to have investments that always go up and never go down. Those things are wonderful, but unrealistic the longer you do this business. But what we can do is work very hard to make sure that what you're expecting is what we're working to make happen, and those results become obvious as we do our job and you see how this is fitting together. That's my plan. And so the risk reward evaluation is another tool we use to make sure that we understand what you want, you understand what we're thinking, and that we have a good way to communicate that out. Not to say this is perfect, it'll never have a problem, but rather to say this is imperfect, let's figure out what the best way to make this work for you is. So now we come to the third tool, your financial dashboard. So your investment dashboard is only for the items that we have for you under our management. And the risk reward evaluation, or Riskalyze, is also something that we provide for you to access. Not every one of our clients does it. We try to get them to do it, but you're all adults. I can't make you do anything, but I definitely encourage you to do your risk reward review so that we know that we're matching up what your expectations are. Your financial dashboard, this is a dashboard that is available to all of our clients as well, although less people do this than the other two that I just showed you. This is designed to help give you tools to track what's going on. If your accounts are linked to it, and understand this software is bank grade encryption, your bank, no matter, I'm not going to name any bank names, but your bank would only work with this software if they had a written signed agreement where they had decided that they felt comfortable the security protocols were satisfactory for their customers, our clients. Same thing's true with credit card companies. Same thing's true with your 401k plan. Same thing's true with everything that we report online through this application to update your information on a daily basis. And with that in mind, if they've agreed that this is safe, then you should have confidence about that too. Now, one other thing about this. This particular software comes in 2 versions that we use. For clients that have a full-on comprehensive financial plan, we have an advanced version. There's a fee attached to it, but in my opinion, based on some of the things that I'll show you, it is very much worth that fee. And then for those who don't want to have a comprehensive plan, but they like having the planning software available for them to do a few things, that is a foundational model. Doesn't have the extra bells and whistles on it, doesn't do some of the things that the other one does. Matter of fact, quite a few of the things, but it does enough that the average person will be like, hey, you know what? This has helped me know what I need to know, and I'm good with that. We're happy to provide that to all of our clients. But as I'm operating in this mindset of saying a fiduciary is a person who's really working to help you maximize what you have, the advanced version of this particular application is what I love to work with, because it can really drill down and answer questions that help you determine your direction as well as the potential destination where you're headed with this. So the first thing it starts with is a baseline wealth advisor extrapolation. And again, I would remind you, financial calculators, whether they're ours or anybody else's, are just a way to analyze information and help make predictions. They can't guarantee outcomes. Now we take this and we use this to review what we call your up and your NPV squared. Your unique personalized possibilities, because everybody's different. After all these years, I've never met anybody who has exactly the same situation as somebody else. And your net present potential values, NPV squared, that kind of shows us that direction where it's going. So we can see with the up where we are today. We can also see expanding out to the future what that looks like, or at least what it could look like. And it helps us think through the process of, is this the right strategy or not? Now, along with it, I'm going to share with you that if you've done one of these reviews with me, you've heard me say before, I only really focus on the first 5 to 7 years. I think this is all wonderful up here, but there's no guarantee this is going to happen this way. It just simply shows us that on the current track we're on with a straight line analysis, it probably could look like it's capable of looking like that. How about that? But these first 5 to 7 years, that's what we're focused on, because that then determines the rest of this. As we go forward year over year over year and keep updating this and working with you on it, we're going to have that ability to look out 5 to 7 years in the future. Not that we can guarantee it, but rather that we can at least make sure that the direction we're headed is the direction that makes the most sense for you. In a retirement sense, for those of you who've heard me talk about this before, there is a red line, a blue line, and a green line. The red line is where you run out of money before you run out of life. The blue line is the sort of average of what most people see, where it goes up for a while and then curves over and starts heading down as the cost of living exceeds the ability of their assets to produce. And then the green curve is what we call the runaway green curve. That's for the person who their income is more than their outgo, and so therefore their assets just continue to increase. And we talk about how to maximize ROL in that strategy, as well as in the blue line also. That's why we have the up and the NPV squared to help you think through the process. Now, 2 examples of that, using our test case here, Harry Arm, we've identified, well, what if Harry had a long-term care need at age 70? And we can see from here, this is what it looked like before, but without having long-term care coverage, we can see what happens to Harry's finances over that period of time. And then what happens if he passes away to his wife, Mary, what happens in her situation? It helps us identify a stress-tested model to say, hey, the first one looked really, really good, but the second one with some challenges added to it might be problematic. So we can then decide, what should we do with that? Might decide to do nothing. Client might be like, I'm not going to worry about it. I have kids, they'll step in, in this example with long-term care. Or they might say, you know what, let's take a look at resources that could fix that. That's part of that fiduciary thinking in my mind, that's helping people assess where they are, move forward wisely with their situation in mind. Not mine. I'm not here to say, Harry, you have to buy long-term care. It may not make sense in his situation. But with this information, Harry and Mary can then make a much better decision. Or we could also look at it this way: an opportunity, stress testing a wealth advisory opportunity, in this case, a business succession strategy, where the person sells their business and they're trying to figure out, if I sell my business, what's that going to look like? What am I going to have to deal with? How would that work in the future? So the green line shows us what happened, and this supersedes what the blue line was before, and now we see all the upside growth. Again, no guarantees, but a way to identify potentially what could happen so we can make smart decisions or wise decisions with that. So with that in mind, we use this software to help people think through decisions that may be, significantly impactful in their financial life for both today and their immediate family needs and long-term strategies. And this is one of the tools we use to help do that. Your financial dashboard gives us all kinds of data so that we're not guessing, we're actually making good decisions based on your situation to make that happen. We also can take a look at wealth transfer. Remember, there's the accumulation phase, the decumulation phase, and then the wealth transfer phase. And so looking at Harry and Mary's situation here, we can see that today, and that's what we're looking off of here today, there states this: if Harry were to pass away first, we can see what taxes and fees would be, what expenses would happen, and then what would come to Mary's estate. And then when Mary passes away, we can see what the taxes and expenses are, as you can see it down here as well, and what goes to the heirs. Now then we can take this same information and we can bump it forward a few years into the future and see what happens. And we can see the change of numbers, we can see the increase in taxes, we can see the increase in distribution. And quite honestly, and while I've done this in previous meetings, I think September and October I reviewed this with you, we can take a look at, well, my goodness, 2.3 million, 2.4 million in taxes, is there anything we can do to reduce that? And the answer is we can. That's what the purpose of this is not just to create a will or a trust, a power of attorney, all these things, but to actually start saying, well, okay, so if this is what I have, how would I take these numbers and make adjustments now and in the future to minimize that outgo? Because given the choice of giving $2.4 million, or I guess 2.9 million, I'm sorry, to my to the IRS and the attorneys and the legal system, I'd much rather give that to my heirs. And so is there anything I can do to impact that? And the answer is, sure there is. Not all ideas are created equal, so some might make sense for you, others might not. That's why we want to take time to look at them and then identify strategies to say which one creates the best outcome for your family wealth. Again, about creating, growing, protecting, and preserving wealth. Fiduciary thinking, how do we help do that? If I simply say to a person, well, let's use Fund ABC. Maybe Fund ABC is a great fund. Maybe I've even talked with them about, well, so tell me what your risk tolerance is. Tell me what your liquidity needs are. Tell me what your income needs are. Maybe I've gone through all those questions. I understand their situation for that one fund. That's great. But from my viewpoint, thinking in terms of wealth advisory, these are some of the tools I like to use to help accomplish what people are really trying to get to create wealth, grow it, protect it, and preserve it, and maximize ROL, whatever that is for them. And it's easier to do when you know enough information about them. And I would point out, because I know the broker dealer, the compliance people are making sure that we want you to understand this. Again, this is not guaranteeing an outcome. It's identifying a direction so we can make a good decision. You can make a good decision. Now, this brings me to the last of our apps we do. It's called MyFLP. And MyFLP is honestly one of my favorite things to do with people, to work with them on. It's the one we've got the least people that are using, and I wish we had more people using it. The ones who are doing financial planning with us as wealth advisory, they are doing it, because what it does is identifies 62 life transitions and 53 life goals, and helps people identify in the next 18 months, these are some things I need to focus on, and over my lifetime, this is what I want to focus on. And then not only does that, but it gives them nifty tools on how to understand, well, so like here, child entering adolescence, there's resources that we pull from this site that help them identify basic thoughts about it, educational resources, understand financial implications, take steps in moving in the right direction. This is how we tie the facts of a person's situation, the financial facts, to the feelings that they want to accomplish, and this is how we can maximize ROL. So when we look at your potential life transitions and your desired life goals, and we begin adding that back to the facts of your situation, it creates a great financial life planning assessment that we can do year over year, not just to identify how do we grow wealth, but even more importantly, how do we enjoy it? How do we maximize the use of it to accomplish what's important to us? Because in the end, what I really look forward to, and you'll notice the bottom of this little chart on the ROL return on life review, and again, only the people that are doing planning have actually seen this work. But what we're looking at is being able to look back. Let's imagine that it's right here, it's 2038. I want to be able to look back, and all these, you can click on them and it shows you details. I want to be able to look back and see, well, this is what we accomplished in 2023, and accomplished this in 2024, and accomplished this in 2026. These are things that maximize return on life. And truthfully, what I've observed over time is that it helps people recognize I am moving forward. I am getting things done. I am accomplishing items that are important to me so that as I take my last few breaths of air on this planet, I can say, I've done what I wanted, I've done what I felt called to accomplish. To me, that's the value of fiduciary thinking as we go forward and have a way to track information, have a way to analyze information, have a way to extrapolate information, and then have a way to assess, evaluate what we've done in the past with that. Now, the way we do this for our planning clients is broken out into 3 trimesters, roughly 4-month periods of time. First trimester is focused on planning review, planning renew, where we take a look at what we've done in the past, take a look at what you want to do in the future, and build a process from January through the middle of April to make that happen. Then the second trimester is where we do investment and insurance review and renew. We take a look at what we've done in the past 12 months, we take a look at what we've done, what we expect to do in the next 12 months and how that relates to your wealth advisory model, the plan we put together. And in the last trimester, starting in September and going to middle or just before the end of December, that's where we put our interest into tax review, tax for the current year, and then tax for long-term thinking, what we expect for income tax issues, estate design, beneficiary review, how do we minimize income taxes, estate taxes, taxes, fees, and expenses associated with estate design. Now, I want to point out, I am not an attorney, nor I'm an accountant. We use software that goes through the information, identifies information for you, information that you can take back to your accountant, your attorney, and put into best practice to accomplish that. But you go in armed with a lot of information to make good decisions. Now, while we're operating with this and our commitment to meet with you and do this, the fact is we're always available to answer questions. And just because you want to do a review, but it's back here of your investments, we'll do that. That's not a problem. I did one of those today. But the reality is that we're committing in our wealth advisory client schedule that we're going to take 3 times during the year and make sure we're focused on getting those answers for our clients so they're getting the best answers for their situation that we can provide. So what's the difference on our advisory thinking? Well, so those financial dashboards I just showed you, they're available 24/7, 365 for your financial needs. For your linked accounts, it's daily updating of that information and your net worth. A consolidated reconciliation available for all those linked accounts to make it so it's easier to reconcile your reports and reconcile your accounts to avoid identity theft and things of that nature. A really great report suite available for all of your important reporting needs, whether it's to the bank or to get a loan or to your accountant to get some information done. Great resources there. An electronic vault available 24/7, 365 for your critical document safety and needs. So if God forbid something happens in a hurricane or a fire destroys your house, you can't get to your box, everything stored in this safe can be printed out and available to you. This electronic vault would have that available for you. I just reviewed the trimester advisor reviews for your family's wealth advisory needs. During those meetings, we take a look at immediate long-term tax strategies review, annual beneficiary, estate design, tax and expense review, annual risk management assessment for your insurance programs, annual investment policy evaluation for your risk to reward strategy, an annual review of your directly managed assets, an annual review of your indirectly managed assets. Things, again, directly is AUM, indirectly is AHA, assets held away. An annual review and update of your life goals and life transitions and those achievements connected to that, what we've done so far. A monthly investor update that is designed to help you be able to understand what we think's going on and be able to ask questions. And then obviously client requested reviews anytime you need. And because we have all this information set up, much easier to answer your questions for you. So let me take a moment here. I am just at the 1 hour mark, but I have a few minutes. I'll answer questions if there are any. I don't see any yet, but I will move a little slowly here. So if you have one you're typing up, I'll watch for it. But I'm going to jump ahead here. So our next update is February 21st. I am not going to be in town on the 3rd Tuesday, so we had to move it to the, is that right? February 20, no, I'm sorry. Nope, that's right. This is the right one, February 21st. And again, we're going to continue down this path of talking about how to create, grow, protect, and preserve your investments for your family wealth and your family income. Again, you know, the market, the economy, those are things that I can report on and share with you what we see and try to help you assess what we think is going on. But the real power comes from taking all of the pieces we just talked about and identifying your journey and your process to maximize that. We will take time for market fundamental and technical analytics, as well as economic analysis and expectations. And depending on what we find between now and then, might spend a lot more detail on that next time. It just kind of depends on what we're working with. Also looking at planning, investment, insurance solutions for you and your family, and for those entrepreneurs on here, your business. And then, as always, available to answer your financial questions. So we reviewed the market and the economy, the portfolio diversification, looked at fiduciary responsibilities to help you have a little better understanding of what fiduciary means to me, and hopefully that matches what makes sense to you. There's a commercial for a firm I see every once in a while, and they're like, we're fiduciaries. Well, good job. It's about time. You know, being a fiduciary is a decision, and it's the tools and strategies and techniques that you use to help understand a person's situation and then try to put together the best outcomes and decisions for that. Not for guarantees, but rather to determine direction and destination. Hopefully the financial dashboards, I know that, again, some of you are using them, but many of you aren't using as many as you should, and I really want to encourage you to do that. I spend a lot of money and time and energy on putting those in place and helping clients to use them because I think they're amazing. I personally use them. Hopefully I still don't see any questions yet. So as always, I'm sure I've either explained everything so well you have no questions, or you're so totally confused you don't know what to ask. So if it's that second one, please email me. And I've reviewed the next investor update. If you have questions about this after we finish tonight, you certainly can email me. You can also invite your friends if you would like somebody else to come and see this, or you would like to send a copy to this. One, it's on our website. It usually takes a couple of weeks to get it on the website, but it is on there. And we can even send links out to friends if you let us know, and we'll, once it's approved by the broker-dealer for upload, we can then send that out as well. But just do that by emailing Kayla@franksoffice.com, and we'll be happy to help with that. Again, I'm assuming every one of you knows our website, but it's www.frankreynoldscompany.com. So hopefully that will help as well. All right, well, I do not see any questions. I do not see any raised hands. So I'm going to assume that you got everything you needed tonight. And if after we hang up, you have more questions, please reach out tomorrow. I'd be honored to help answer those questions for you. Our staff does their very best to help everybody get what they need as they need it. I will tell you, we've been extremely busy the first part of this year, and we are trying to catch up on a few things, but we will absolutely do our very best to help you with whatever you need. So having said that, I think I'm going to go have a hamburger with Wyatt and have a conversation about a couple of things that have been happening, and then I'm going to enjoy the rest of my evening, and I hope you do the same as well. Thank you for your time tonight, and I look forward to talking to you all soon. Don't be a stranger. If you need anything, we're here for you, but until then, have a great evening, and God bless.